The Hidden Laws of Wealth Series, Decoding the Market via Microeconomics. Chapter 1, The Cruel Game of Scarcity, Part 1. Welcome to the shadows of the financial world. If you are listening to this, chances are you have lost money. You have stared at the red numbers on your screen until your eyes burned. You have felt that sickening drop in your stomach when the market crashes. And you have wondered why. Why does the market behave like a wild beast? Why do logical decisions lead to losses, while insanity seems to be rewarded? Forget what you learned in business school. Forget the colorful charts and the smiling analysts on television. They are selling you a dream. I am here to tell you the truth. Today we are going to strip away the noise. We are going to look at the engine that drives every single price movement, every bubble, and every crash. We are going back to the very root of human behavior, microeconomics. But this is not a lecture. This is a survival guide. Let us begin with the first and perhaps the most brutal rule of the game: scarcity. Most people walk into the stock market thinking it is a land of infinite opportunity. They see thousands of ticker symbols. They see endless news feeds. They see billionaires being minted overnight. They think money is abundant. They are wrong. The market is not a place of abundance. It is a place of extreme scarcity. And the most scarce resource is not gold. It is not oil. It is not even information. The most scarce resource is your capital. In economics, we define scarcity as the tension between unlimited human desire and limited resources. In the market, this tension is what kills 90% of traders. Think about your own mind. You want to buy the dip. You want to chase the breakout. You want to hedge your portfolio. You want to own the next big tech stock, but you also want the safety of high dividend banks. Your desire to make money is infinite. There is no limit to your greed. But look at your account balance. That number is finite. It has a hard limit. When you bring infinite greed into a finite environment, you create chaos. Every time you click the buy button, you are using up your life force. You are depleting your ammunition. The amateur trader sprays his bullets everywhere. He buys a little bit of this, a little bit of that, chasing every shiny object. He ignores scarcity. And when the real opportunity comes, the opportunity of a lifetime, the one trade that could retire him, he has nothing left. He is empty. The professional, the one who survives, understands scarcity in his bones. He knows that he can only pull the trigger a few times a year, maybe even a few times a decade. Because capital is scarce, every decision to buy must be weighed against the crushing reality that you might be wrong. This brings us to the second concept, the shadow that follows scarcity: trade-offs. There is no such thing as a free lunch. You have heard this before, but do you really understand it? In the market, a trade-off is not just about money. It is about your soul. It is about your peace of mind. Every stock you own carries a hidden price tag that is not shown on the chart. If you want high returns, if you want to double your account in a month, the trade-off is your sleep. You will have to watch the charts 24 hours a day. You will have to endure swings of volatility that would make a normal man have a heart attack. You trade your peace for potential profit. If you want safety, if you want to sleep until noon like I do, then the trade-off is excitement. You have to buy boring companies. You have to accept that you will not get rich tomorrow. You trade the thrill of the casino for the certainty of the landlord. Most people try to cheat this rule. They want high returns with low risk. They want to be a lion, but sleep like a sheep. The market punishes these people the hardest. The market destroys them. Let me give you a real example from the trenches. Imagine a market crash. Prices are falling. Panic is in the air. This is a moment of extreme scarcity. Liquidity, the ability to sell, disappears. Everyone wants to sell, but no one has the cash to buy. The amateur panics. He sells at the bottom because he cannot handle the pain. He trades his future wealth for immediate relief. That is a bad trade-off. The master, the one who understands the game, does nothing. He sleeps. He waits. Or he steps in and buys when there is blood in the streets. He trades his short-term comfort for long-term dynasty. You must view your portfolio not as a collection of lottery tickets, but as a battlefield of limited resources. Every soldier you send out to fight in a bad stock is a soldier who cannot protect you when the enemy attack. So before you make your next trade, ask yourself this question. Not how much money will I make, but what am I giving up to take this position? Am I giving up my cash reserves? Am I giving up my mental clarity? Am I giving up the chance to buy something better tomorrow? Because the market is a cruel mistress. She does not forgive waste. Now you might be thinking, okay, I understand scarcity. I have limited money, but how do I know if I am making the right choice? How do I measure the cost of my decisions? This is where it gets dangerous. Because the true cost of a trade is never the commission fee. It is never the spread. There is a ghost in your portfolio, a silent killer that eats away at your wealth while you are celebrating your small wins. It is a concept that separates the wealthy from the working class. It is called opportunity cost. And in the next part, I'm going to show you how this ghost has been stealing from you for years without you even noticing. Stay tuned. The Hidden Laws of Wealth Series, Decoding the Market via Microeconomics. Chapter 1. The Cruel Game of Scarcity, Part 2. The Ghost in Your Portfolio. Welcome back to the Underground. In the last session, we talked about scarcity. We talked about how your capital is finite, and every decision to buy is a decision to burn your ammunition. But today, we need to talk about the ghost. Remember I told you there is a ghost in your portfolio, a silent killer that destroys more wealth than any bear market in history. Its name is opportunity cost. In the textbooks, they define opportunity cost as the value of the next best alternative given up. It sounds boring. It sounds academic. But in the real world of trading, opportunity cost is the smell of burning money. It is the profit you did not make because you were too busy protecting a mistake. Let me paint a picture for you. Imagine you bought a stock. Let us call it Company A. You did your research. You felt good. But then, the market turned against you. The price drifted down to $40. You are down 20%. Now the amateur trader looks at this and says, I have not lost anything until I sell. I will just hold it. I will wait for it to come back to $50 to break even. Then I will get out. This is the most dangerous lie in finance. I will wait to break even. While you are waiting, sitting there with your dead money trapped in a losing stock, the world is moving on. Across the street, in Sector B, a new trend is emerging. Maybe it is artificial intelligence. Maybe it is a shortage in industrial metals. Stocks in that sector are moving. They go up 10%, then 20%, then 30%. But you cannot touch them. You are paralyzed. Your capital is tied up in Company A, hoping and praying for it to recover just to get your original money back. So, what is your real loss? It is not just the $10 per share you lost on Company A. No, The real loss is that $10 plus the 30% gain you missed in Sector B. The ghost of opportunity cost has stolen that 30% from you. And the worst part? It does not show up on your monthly statement. Your broker does not send you a bill for opportunity costs. It is invisible. And because it is invisible, you ignore it. This is why the poor stay poor in the market. They focus on the visible loss. They try to avoid pain. The rich, the masters of this game, we focus on the invisible cost. We ask a different question. We do not ask, how much will I lose if I sell now? We ask, what else could this money be doing right now? If the answer is that this money could be working harder somewhere else, then we sell. We cut the loss without emotion. We execute the prisoner. We take the capital, even if it is smaller than before, and we move it to the winning battlefield. This brings me to the most misunderstood asset in the world. Cash. Most people hate cash. They have been brainwashed by economists who tell them that inflation is eating their savings. They feel a burning need to be fully invested at all times. They think if their money is sitting in a brokerage account, doing nothing, they are losing. Let me tell you a secret. Cash is not nothing. Cash is a position. In fact, cash is the most powerful position you can hold. In microeconomics, cash represents pure potential. It is the ultimate liquidity. When you hold cash, you are holding a call option on every single asset class in the world with no expiration date. You are the sniper waiting in the bushes. The amateur is the machine gunner. He fires all his bullets in the first 5 minutes. He is fully invested. He owns 20 different stocks. He feels productive. But then the crash comes. The black swan event. The moment when blood is in the streets. Prices collapse. High-quality assets are selling for pennies on the dollar. This is the moment generational wealth is made. But the amateur cannot buy. He has no cash. His opportunity cost is infinite because he gave up his liquidity for mediocre returns. The sniper who sat on cash for months, enduring the boredom, enduring the mockery of his friends who were making small gains, now steps out. He buys the panic. He buys the fear. So, opportunity cost teaches us a vital lesson. Doing nothing is often more profitable than doing something mediocre. Every time you are about to buy a stock just because you are bored, or just because you saw someone mention it on a forum, stop. Think about the ghost. Ask yourself, is this trade worthy of my scarce capital? Is this the absolute best use of my money right now? Or am I just filling the void? Because if you fill your portfolio with trash, you have no room for treasure. I want you to do an exercise tonight. Look at your portfolio. Look at those red positions you have been holding for months, hoping they will come back. Imagine you do not own them. Imagine you have that amount of money in cash right now, sitting on your desk. Would you buy those stocks today at the current price? If the answer is no, then why are you holding them? You are holding them because of another psychological trap. A trap that binds you to your past mistakes and blinds you to the future. It is called sunk cost, and it is the twin brother of opportunity cost. In the next part, we are going to walk into the graveyard of bad investments. I am going to teach you the art of the ruthless cut. I am going to show you how to amputate the infected limb to save the body. Because in this game, if you cannot take a small loss, you will eventually take a fatal one. To be continued. The Hidden Laws of Wealth Series, Decoding the Market via Microeconomics. Chapter 1. The Cruel Game of Scarcity. Part 3. The Art of the Amputation. Welcome back to the darkness. We have talked about the scarcity of your capital. We have talked about the ghost of opportunity cost. Now, we must face the monster. The monster that lives in the gut of every trader who has ever blown up an account. It is called sunk cost. In economics, a sunk cost is a cost that has already been incurred and cannot be recovered. It is money that is gone. It is history. The textbook says a rational person should ignore sunk costs when making a decision about the future. But you and I know that in the market, ignoring the past is the hardest thing in the world. Let us be honest. You have a stock in your portfolio right now. You bought it a year ago. You spent weeks researching it. You told your friends about it. You felt like a genius when you pressed the buy button. But now it is down 40%. Every time you look at it, you feel a sharp pain in your chest. You remember the money you worked hard to save. You remember the dreams you attached to that trade. And then the voice in your head speaks. It says, I cannot sell now. I have put too much into this. If I sell now, I am admitting failure. If I sell now, the loss becomes real. As long as I hold, there is hope. That voice is the voice of the sunk cost fallacy. And that voice is going to bankrupt you. The sunk cost fallacy is the lie that tells you to dig a deeper hole just because you have already spent all day digging. It is the lie that tells you to throw good money after bad money. In the casino, they call this chasing losses. In the boardroom, they call this escalation of commitment. In the stock market, we call it being a bag holder. You are holding a bag of rocks, hoping they will turn into diamonds, simply because you paid a high price for the rocks. Let me give you a moment of brutal truth. The market does not care what price you paid. The market does not care how much time you spent analyzing the chart. The market has no memory of your entry price. The stock is trading at $30 today because that is what it is worth today. The fact that you bought it at $50 is irrelevant to its future movement. When you make a decision based on your entry price, you are driving a car while looking only at the rear view mirror. You are going to crash. So, how do we defeat this monster? How do we master the art of cutting losses? You must treat trading not as a hobby but as a business. And sometimes, in business, you have to fire an employee who is stealing from you. Think of your losing position as a toxic employee. This employee is lazy. He is losing money every day. He is bringing down the morale of the whole team. Would you keep paying him just because you hired him a year ago? Would you say, I cannot fire him because I spent so much time training him? No. You would fire him immediately to save the company. You must do the same with your stocks. I am going to teach you a mental trick. A technique I use when I am trapped in the sunk cost prison. I call it the zero base reset. When you are staring at a loss, and you cannot bring yourself to sell, close your eyes. Imagine that you have 0 positions. You are 100% in cash. Now, open your eyes and look at that stock. Look at its current price. Look at its chart. Look at the company fundamentals as they are right now. Ask yourself, if I had cash in my hand today, would I buy this stock at this price? If the answer is no, then you must sell immediately. Because if you would not buy it today, then holding it is a contradiction. Holding it is the same as buying it again every single morning. Cutting a loss is not a failure. It is a surgical procedure. It is an amputation. Yes, it hurts. Losing money feels like physical pain. But would you rather lose a finger? Or would you rather lose your whole arm? When you cut a loss, you are not admitting defeat. You are saving your capital for a better war. You are stopping the bleeding. You are taking back control. The moment you sell, the pain disappears. It is magic. The anxiety vanishes. The hope vanishes. and suddenly you have clarity. You have your cash back, and with cash comes power. Many traders spend their whole lives trying to get their money back from the specific stock that took it. They want revenge. They want the stock that fell to be the one that rises. The market does not owe you a refund. You can lose money on a tech stock and make it back on an oil stock. Money is fungible. It is all the same. Do not get emotionally attached to the vehicle. Focus on the destination. Sunk costs are the anchors that keep your ship in the harbor while the rest of the fleet is sailing to the new world. Cut the anchor. Sail away. But why is this so hard? Why does our brain fight us every step of the way? Why do we feel like we are dying when we take a loss? It turns out we are not built for the stock market. We are built for the jungle. Our biology is working against us. In the next part, we are going to dismantle the biggest myth in economics. The myth of the rational actor. I am going to show you why you are biologically programmed to lose money, and how you can hack your own brain to win. Stay tuned. The Hidden Laws of Wealth Series, Decoding the Market via Microeconomics, Chapter 1. The Cruel Game of Scarcity, Part 4. The Myth of the Rational Man. Welcome to the finale of Chapter 1. We have talked about money. We have talked about choices. But today, we need to talk about you. The biological machine that is sitting behind the screen. If you open a standard economics textbook, you will find a character called Homo economicus, the rational man. According to the theory, this rational man always acts in his own best interest. He calculates probabilities perfectly. He has no emotions. When he sees a loss, he cuts it. When he sees a profit, he maximizes it. But let me ask you a question. Have you ever looked at a losing trade, known you should sell, but your finger just refused to click the button? Have you ever sold a winning stock way too early, just because you were afraid the profit would disappear? If you have, then you are not the rational man. You are a human being. And being human is a disadvantage in the stock market. The biggest lie they teach in school is that markets are efficient because people are rational. The truth is, markets are chaotic because people are emotional animals. We are not built for the stock market. We are built for the jungle. In the jungle, if you see a predator, you run. That is fear. In the jungle, if you find food, you eat it immediately because it might rot tomorrow. That is instant gratification. But in the market, fear makes you sell at the bottom. And instant gratification makes you sell your winners too early. Your survival instincts, the very things that kept your ancestors alive, are the things that are killing your portfolio. This brings us to a concept that explains almost every mistake you have ever made. It is called loss aversion. Psychologists Daniel Kahneman and Amos Tversky discovered something fascinating. The pain of losing money is psychologically twice as powerful as the pleasure of gaining money. Losing $1,000 hurts 2 times more than gaining $1,000 feels good. Think about that. The ratio is 2 to 1. This is why you hold on to losing stocks, because realizing the loss causes deep psychological pain. Your brain will do anything to avoid that pain. So you hold, you hope, you pray, you delay the pain. And this is also why you sell winning stocks too early, because the moment you see a small profit, you become terrified of losing it. You want to lock in the feeling of winning. So you sell for a small gain, and then you watch the stock go up another 50% without you. You cut your flowers and you water your weeds. This is the exact opposite of what a rational economic actor would do. So, If our biology is programmed to fail, how do we win? How do we become the wolf instead of the sheep? The answer is simple, but it is not easy. You must stop being human. You must become a system. The wealthy do not rely on willpower. We rely on rules. We build algorithms not necessarily on a computer, but in our minds. Rule number 1. I never enter a trade without knowing exactly where I will exit if I am wrong. This removes the decision from the moment of panic. Rule number 2. I never look at the money value of a trade. I only look at percentages. Money is emotional. Percentages are data. Rule number 3. I accept that losing is part of the game. I treat losses like the operating expenses of a business. A restaurant buys food that sometimes goes bad. They throw it away. They do not cry about it. They do not hold on to rotten meat, hoping it turns fresh again. By building these rules, you bypass your monkey brain. You bypass the fear. You bypass the loss aversion. We have reached the end of chapter 1. We have learned that capital is scarce. We have learned that every choice has a cost. We have learned that the past does not matter. And we have learned that our own brain is the enemy. Now that you have the mindset of a professional, you are ready to look at the market itself. You are ready to see the invisible forces that move prices up and down. You are ready to understand why a piece of bad news can make a stock go up, and why a record profit can make a stock crash. In Chapter 2, we are going to pull back the curtain on the great engine of capitalism: supply and demand. Not the version you learned in school. We are going to talk about the supply and demand of the whales, the market makers, the people who control the game. Get some rest. The real training begins in the next episode.